A conversation with the Secretary of the Treasury of the United States, Mr. Tim Geithner. It's a great pleasure and a great honor, Tim, to have you amongst us. We've had a busy conference which has started yesterday and just sort of finished now, or is about to finish after our interview. And we essentially covered matters related to the regulation and the supervision of the financial system. The gist of this conference is not to hear, speeches and things like that. It's a way of bringing together the private sector, which was very well represented today, all the major international institutions, European, American, Asian, and ask them to exchange views with the regulators, the central bank governors and ministers. So it's a very sort of Socratic, if I may say so, discussion where positions are very free and very frank. And we are particularly happy and privileged to have you at the end of this session. I will ask you a few questions and feel free to answer in a, as you like. The first question is a bit general, but it will allow you to set the stage. It's about what are the main priorities of the US-Treasury for the G20 meeting, which is starting today, and your views on the global recovery and also the economy in the United States.
Jacques, very nice to be here with you, and thanks for letting me come, even though I'm not formally a regulator. And always good to get some advice on how we should find a better balance and how we bring about these reforms in a sensible way. Our agenda, like the G20's agenda, is shaped by the shifting challenges facing the global economy. I think the global economy, by almost every measure, is in really better shape than it's been any time in the last 2 or 3 years. I think there's justifiable growing confidence. I would say it's a wary, measured confidence, but justifiable growing confidence in the sustainability of the expansion. And you're seeing the challenges and risks shift. We have a situation now where, of course, the emerging world's growing, much of the emerging world's growing very, very rapidly. They're facing the classic challenges of how to make sure they can use monetary policy to help contain inflation pressures in those countries. Europe seems to be making some progress towards strengthening the financial framework and sort of in support of reforms to help the countries in Europe that need reform and need financials to manage through that challenge. I think it's good to see that happening, and I think the markets are showing, again, more confidence, more optimism in the political commitment of Europe to address those challenges. And the U.S. economy is gradually accelerating again, and I think if you look at forecasts, most people see a world in which the emerging world is growing 5-6%. We're growing between 3 and 4%. Europe and Japan somewhere between 1 and 2% if you look over the next 2 years or so. And that seems a reasonable forecast. So the main challenge that we face today, of course, is how to sustain that recovery. And as we do that, we're trying to do two very important things. We're trying to make sure this basic framework of better designed financial oversight reforms are put in place in a way that will give us a better balance between stability in the future and the types of efficiency and innovation we need from our financial markets. And we want to make sure we do that on a more uniform basis globally for reasons you all understand as well as we do. And we're also trying to build a initial consensus on a set of longer-term reforms to the international monetary system that would, again, offer the prospects of a more stable, more resilient global economy, less prone to large imbalances, less prone to the types of huge volatility in growth outcomes, in exchange rates and capital flows that you tend to see. And we're at the early stages, again, of trying to set the terms of what I think should be a very important debate over the longer term of how to build a system that has a better balance of incentives and norms, standards around things like exchange rate policy in large, open, emerging economies, how to use prudential measures to limit the risks of capital inflows, large volatile capital flows, how to set incentives to prevent the reemergence of large external imbalances, all alongside this challenge of trying to make sure this framework for financial reform is done in a sensible, balanced way. Again, make us less prone to financial crises in the future, less vulnerable to risk shifting to where the standards are lowest, and still preserving the necessary incentives, opportunities you need for a more innovative, efficient financial system. So those are our challenges. Fundamentally, they're better challenges to have than the ones we faced, again, any time over the last 3 years or so. And I think we got to make sure we keep our eyes on the basic imperative we face, is to still make sure that we're working to heal the damage caused by this crisis and get stronger growth, more sustainable growth in place more durably, particularly in the major economies.
In this respect, how do you look at indicators, specific indicators that can be the sign or the manifestation of some imbalances, and what to do with those indicators?
Well, of course, you have to look at measures of imbalance. There's no alternative. And you need to look at measures of external imbalance, like the current account, as well as the types of symptoms people look at for internal imbalance. So I'm sure you'll see the world move in that direction. And again, think about what's at stake here. You need to have a system in which you have better incentives for countries to run policies that are less vulnerable to, makes the world less vulnerable to the reemergence of those imbalances that we saw in the run-up to the crisis. Why does that matter? It matters because if you let that happen, then future growth rates will be more at risk and financial stability will be at risk. And so there's a very strong incentive you see across emerging economies to make sure, again, we have better norms in how you think about exchange rate policy, a framework for how you reduce the risk of reemergence of large imbalances, what we call this external sustainability indicators, and better consensus on the use of prudential measures in particular to limit the vulnerability of financial systems to big swings in capital flows.
Thank you very much. And I suppose that the role of the IMF in that process is important.
Is central,
yeah,
I would say.
Yeah.
I mean, again, why does the IMF exist? In part because we need to have an independent, objective source of assessments about the implications of the policies we each pursue, including the United States, on the world as a whole. And there is no alternative to the IMF for that purpose. The IMF will not be perfect, but it'll be more acceptable, more legitimate than any of the alternatives.
Thank you very much. Let me move now to subjects that were more discussed today and yesterday in our sessions. And although you did make clear that you are not a regulator, you nonetheless have ideas on the subject. One question we had was that the European Council, Parliament, Commission have designed a system for the supervision of financial institutions in Europe. It's a system where the individual national supervisors do the daily job, as they used to, but there is a sort of a center at European level that sees to it that these different national supervisors do I would say, consistent or coherent job, and that the rules that are being applied nationally are indeed common rules, which was not the case previously. We had directives, which was the law part, but it was translated into national legislations through the 27 countries in very different ways. So now we have three authorities, one for banks, one for markets, one for insurance companies, that are going to see to it that rules are the same, not harmonized, the same. It's a big leap forward. We're not yet there. It's the very beginning. And then there is this systemic risk board, which is a bit similar to the system that you have in the United States. It's the Dodd-Frank legislation. And the question we had was, if the Europeans are trying to unify and in a way simplify their system, isn't it perhaps a bit paradoxical that in the United States, although many measures have been taken under the Dodd-Frank legislation, in terms of the structure of the supervision, the complexity, if I may say so, and the fragmentation of the system has almost survived. Does that lead you to some considerations?
Well, I think the most important thing to fix in the US, I think this is true globally, is to make sure that the design of the basic constraints on leverage and risk-taking, capital, liquidity, the oversight of derivative markets, the limitations on the parallel shadow financial system, those sets of things, you get the rules designed better. They were not well designed. They were not well applied, not just in the United States, but in many places. And they need to be applied more uniformly within financial markets, across people engaged in the business of lending and raising capital. And they need to be applied more evenly across countries. And my own sense is we've made dramatic progress in a framework that meets that basic test, both in the United States and in the early consensus we reached in the Financial Stability Board and the Basel Committee. But of course, the real challenge is to make sure at this point is that it gets put in place in a way that works. The rules get written in a way that reflects a sophisticated understanding of how markets work and the trade-offs involved between, stability and efficiency in that case. And I think it's very important we not lose the momentum that helped drive these early agreements on capital reforms, and make sure we translate that focus and commitment to more consistent application of the rules across and within countries. Now, in the U.S., you're right, ours is a complicated system. And it would be, I think, better for us over time if we were able to move to a more integrated system. But we still have, like many countries, still a system where there is functional specialization, and we have people in charge of supervising banks, in overseeing market integrity, and in providing protection for consumers. So although it's a little bit more diffuse than that, in its simple way, what we've done is try to consolidate around those three critical basic functions. And as you said, we have a council in place now to try to induce, if not compel, more uniformity in design. And I think that's a substantial step forward. Of course, the test is in how this is done. But Chairman Bernanke and his colleagues are doing a very good job of trying to make sure they're working more closely together. And the way our system works, again, this is a great strength of our system, is that we put these rules out for comment. The world can look at them. You get a lot of chance to give advice on how to get them better. And that helps improve the odds that we have it come out in the right place. And we're working very closely with your colleagues in Europe to make sure that as Europe puts in place their framework, we minimize the risk of arbitrage across countries. And we're at the early stage of testing that commitment to harmonization. But so far, I think we're doing better than we have done in the past. Not good enough yet, but better.
Thank you very much. Another question which was raised today was the question of the possible risk, or even perhaps the actual risk, of seeing some transactions which were usually done in the financial sector move out of the financial sector into what is called by simplification the shadow banking system, because if you tighten the rules on the, I would say, the normal under surveillance banking system, there might be a temptation to transfer operations to a less regulated and a more free in terms of the way they act, the way they leverage system. What do you think about that?
I completely agree, and I think you said it right. And that was a principal cause of our crisis in the United States and a principal motivation for the basic framework of oversight that is at the center of the Dodd-Frank legislation. Again, in our system is different from much of Europe, and it's going to remain different from much of the world in the sense that we're going to have a financial market in which banks are probably still going to be roughly 50% of credit in over time, with the broader securities markets providing the balance. The mistake we made in the United States, though, was that we allowed a broad range of institutions to get into the business of financial intermediation without being subject to capital requirements or constraints on liquidity or funding mismatches, and with no oversight of them. And as you know, the consequences of that were devastating. We allowed a huge amount of leverage to build up outside, and when the crisis hit and that leverage collapsed, it put huge pressure on the rest of the system. So that's a very important imperative. We've got to make sure that as we get these rules better designed for capital on the regulated institutions, it doesn't recreate that basic dynamic. And you're right to remind people that that needs to be a check on the ambitions of many to go too far on capital for banks. I don't think we're at the risk of that now, frankly, but it's a good cautionary note to remember.
Yes, the logic of what you just said would be, at least in most systemic cases, to extend supervision, regulation, perhaps capital requirements on that non-banking or parallel banking or shadow banking system, because it's the only way to catch them.
I think only on the parts of it that create that potential source of risk to the system in crisis. So I would not use that rationale to justify, the indefinite expansion of the framework of capital requirements. But not to pick on the U.S. examples, but I'll use the U.S. examples. In the U.S. context, banks had a set of rules. Investment banks had different rules. You could be a finance company and have different rules or no rules. You could be AIG, or you could be, I won't use a bunch of other names, operate outside that system. And for institutions that are fundamentally in the same business of helping companies raise capital, making loans, helping their customers hedge risk, that business, or being integral to the payment system the way markets function, institutions that are on a substantial scale engaging those activities should be subject to a uniform set of constraints on leverage. But that doesn't mean you should extend that to anybody who has finance in the title of their firm. And I think that's a challenge to have over time. What we did in the United States was create a framework where the supervisory system, in this case it includes the Secretary of the Treasury, with some checks and balances, can expand the scope of those constraints to capture institutions that build up to take advantage of that arbitrage opportunity, and it could still present a risk to the system. Now, there's a real risk that we won't be quick enough or agile enough to do that, but we have the authority to do that. We did not have that before.
Yeah. You can do that, by the way, from two sides. You can do it on the side of the regulated system, right, which is a major lender to the non-regulated system, and that is something that is doable. Or you can do it on the side of the, if I may say so, the receiving part of the system in the shadow banking system when you feel, and your committee feels, that those shadow banking institutions are becoming too important, too systemic. So that's the philosophy that I understand.
The challenge, of course, this is a challenge. We don't want to leave the markets with huge amount of uncertainty about what the scope or the boundaries of those restraints are going to be. And so in the U.S., we have a very careful process where really the burden's on us to justify the extension. And again, we're going to be careful. But we won't have perfect knowledge about where we get that balance right. We want the capital requirements to be large enough so we can withstand a shock like this we just experienced without having to go to the taxpayers for extraordinary assistance. But we don't want to get them so high that we make it inevitable that a large amount of risk and leverage just moves to the periphery again, and that's something will be a major challenge for us forever.
Now, that's a major challenge. That is a matter of judgment, I would say permanent judgment, and this has been very much the center of the discussion we had today. I have a last question because I don't want to take too much of your time now. You have to go to the official meetings which you have been coming in Paris. It's on systemically important financial institutions, so-called SIFIs. We had a long set of discussions on that. There is agreement that one must provide such institutions that are systemically important sufficient, I would say, protections, sufficient buffers, sufficient resilience. See, if we want to avoid the repetition of the enormous crises with moral hazard attached to them, etc. But there is a preoccupation in Europe which I would like to explain and ask you perhaps to comment upon. And the preoccupation is this one. In Europe, the proportion of the economy that is financed through banking intermediation vis-à-vis financial markets, is much higher than in the United States. We calculate that 3/4 more or less of the economy is financed through credits that are
on bank balance sheets.
Bank balance sheets, on bank balance sheets. Now, this of course is very costly if you have to put in front of all these credits that are on your balance sheet a sufficient amount of capital. And in a way, if you apply too high a level of capital on those types of banks which have a portfolio that is rather diversified. You've got a lot of retail operations, individuals, corporates, you have some project finance, you have etc. And some investment finance activities. But if you put too high levels of capital, in a way you penalize that type of model because it's a model that has large balance sheets because, you know, economies are large, and if you have a bank that finances a very large sector of the economy, by definition the balance sheet is perhaps larger than it would be if the bank was more sort of investment bank, you know, as you see some in the United States of a more specific nature. So there is a concern amongst those who work in that field to see a one-size-fits-all rule applied to them without the regulator having really assessed with sufficient care, I could say, the relative riskiness of that type of model vis-à-vis other types of models. And I'm summing it up not in a very clear language, but I'm sure you you understand what I have in mind. And that came up very clearly in the discussion. So in a way, we said it's perfectly okay to have rules that should apply to institutions that have been detected as more prone to systemic contagious problems than others, but regulation should be neutral in terms of the business model that is applied, because you have some business models that are pretty solid. You have a very large diversification of your assets, and you have a very strong funding, be it deposit, be it access to long-term funding, it's not very logical, you see, to say, no, you have to reduce your balance sheet, you have to deleverage, you have to reduce your assistance to the economy. So that was a theme that came back and back again during the 2 days we had, and I'd like you to react on that.
Excellent question. I think one of the big challenges we have is if you look at the differences in our financial systems and approach to how we think about regulation between, just to simplify, US and Europe, we still have some big differences. Your banking systems are much, much more concentrated and much larger as a share of GDP than is ours. And to be direct about it, you have much less tolerance for allowing failure of financial institutions. In the United States, we have a much larger capital market in terms of its importance and credit. Those create big differences in approach, the reflection of differences in approach too. Now, if you get capital better aligned with risk, then it should be able to capture fairly the differences in the composition of a balance sheet
Absolutely.
and the risk on a firm. Very hard to do. But the underpinnings, the basic intellectual underpinnings of the frontier of capital reform try to capture that basic difference in business model. I don't think that's the biggest difference between us. The biggest difference between us is we have systems, and you apply this, where I think in Europe there is more willingness and enthusiasm in the balance between, let's say, guarantees and capital, to rely more on the implicit broad guarantees on funding that the state is more willing to provide in parts of Europe than will be true in the US. And I think that leaves some of the authorities in Europe more willing to run a system with lower capital requirements than we think is appropriate in the US. Now, this is an infinitely complicated question, of course, because even in the US, you have a system where our basic view is that the largest institutions should hold more capital relative to risk than our 8,000 community banks, even though they are, by definition, larger, more diversified, and less vulnerable to shocks that might occur in individual parts of the American economy. And the reason we believe that is simply because of we want to run a system where there is the capacity for failure, but large institutions, by definition, cause more damage when they fail or when they come to the edge of failure. So that leads us to want to have a system in which our large institutions, and this is what we feel we achieved in the accord reached last September by the central banks and supervisors, where the largest institutions in the United States are held to a much more ambitious, much more conservative set of requirements on capital and funding, even though, as you say, over time you could say that they're more diversified and therefore, by definition, able to absorb a larger shock than true for the small ones. So no perfect balance here, but ideally, if you get the capital risk weights right, you should be able to capture and minimize some of the concerns you said about discriminating between banks with different types of business models. But that's, like you said in the last issue, will be an enduring challenge for supervisors.
Yeah. Now, I just wanted to add one little thing to what you said. I'm afraid that the sort of benevolence of states to guarantee funding in their banks is
under challenge.
Is something of the past. Yeah. I don't think that is really, something that you can count on. The assistance by the states to the banks in Europe has been much lesser, as you know, than the one that was done in the United States. And there is no leniency towards repeating even that relatively moderate assistance. The only thing I wanted to say, and that's an intellectual point, but also an actual point. The size, I understand size is very important in the US in that concept of systemically important financial institutions. In the case of Europe, the present situation is really that you have banks in countries, some countries are peripheral countries in geographic terms, that are not big. But they are big
within their country.
Right. Related to, the GDP of their country.
Right.
And they're not too big to fail in terms of, global measurements. But they are too big to fail, although they are small, in terms of the havoc they can play in the States and the contagious effect that can play within Europe. So this is just...
Right. But again, I think the best defense against that risk really requires two approaches. One is capital.
Yeah, I would agree on that, yes.
Capital and liquidity, of course, are the most important thing. And unambiguously, the world got those standards wrong. They were not well designed. They allowed for huge differences across countries. They did not capture the extreme tail, the risk of the extreme event. And they lagged dramatically behind the basic dynamics of innovation and finance. And in the US in particular, they were applied to a shrinking share of the financial system as a whole. So getting that right is very important. But the other thing, again, I think this is very important, is that you still have to be able to contemplate failure. You don't want it to happen in the way it happened in the United States, in a way which was devastatingly damaging, unforgivably damaging to the system as a whole. But you have to have a system where you can allow it to happen without causing that kind of collateral damage and contagion. And that requires having a capacity to put banks through a form of bankruptcy, managed bankruptcy, fair, orderly resolution, so that you can stem a panic and failure does not accelerate panics. And that's the challenge we're all trying to work with, but that's running against what I think will remain still a somewhat different tradition and thought. You can even see it between the US and the UK about whether you should allow failure or can allow failure. Now, of course, easier for us to say, again, because we have a system where our system is much less concentrated and is a much smaller share of GDP, and the capital markets exist sort of alongside as a shock absorber cushion in best of times. So again, no easy solution. But I understand the concern you're raising, and it's a good concern. And I do think it's very important that we try to help make sure that as the central banks and supervisors design these rules, they don't, well, just do it. They do it with as much knowledge of the way markets work and the way the system evolves as possible. Better for that to happen, and it's good for them to get feedback from people in the markets on how best to do that. And we'll try to make sure that we reduce the risk that we get the balance wrong.
Well, thank you very much. I would like to thank you very especially because you have provided a very frank set of answers. You really entered into the depth of the questions. Last question, which is very complex, you answered, I thought, with an enormous amount of clarity and also an enormous understanding of what I was trying to reflect. So I would like all of us to reflect the appreciation we have for the Secretary of the Treasury of the United States.
Thank you, Jacques.
Now the Minister of Korean for Financial Affairs will deliver the final speech. Please, you can stay here. Thank you so much.